Hi, my name is David Cataford, CEO at Champion Iron. We operate a high-grade iron ore mine in the north of Quebec, produce around 15 million tons of one of the most needed materials to decarbonize the steel industry. We benefit from over $4.5 billion of invested capital at site, and our balance sheet is very clean to allow us to potentially grow in the future with higher grade material and also more volume.
David, thank you very much for a very succinct and clear introduction. Really nice to meet you. You did an interview with Crux 2 or 3 years ago, and the share price since then has just been really, really solid. You know, you've contrary to most junior or mid-tier or even large cap mining companies, your share price has gone from low to high, bottom left to top right. So, and during that course, you've done this extraordinary expansion, you've doubled your output. So could you just summarize what's kind of accompanied that, let's say, the 2-year kind of share price growth and your key delivery milestones that you've achieved so in that time?
I think if we take a step back and we look at what is a clear differentiator is that management and directors own over 10% of the business. So every time we take a decision, we're fully in line with shareholders because we are a significant shareholders as well. So I think that sets us apart and allows us to focus on the things that will be accretive for our business. And the one that has been the most accretive in the past years has been us delivering one of the largest mining projects in North America in the last 10 years on time and on budget. And this is on time, on budget during a COVID pandemic. And we still managed to hit our targets. So extremely proud of what we've done. And this allows us now to put an extra 7.5 million tons of the highest grade or some of the highest grade material in the market.
You say it's a differentiator. I mean, it's worth pointing out that your market capitalization is 3.5 billion Canadian. It's quite often to find a micro cap stock with management and directors with 10% or more, but not so often when the company has grown to the size that it has. You picked up the Bloom Lake asset from Cliffs in 2016, and it had run out of options and it was no longer profitable, and they had decided to close it. So how did you go about identifying what were the key bottlenecks and the kind of the value drivers of bringing this back online?
Yeah, I think one of the advantages we had is that I have been working at Bloom Lake since 2010. So I saw the 2010 to 2014. I saw also when Cliffs picked up the asset and then invested over $2.5 billion in the asset to fix the original issues. And they were very close to getting to the finish line on most of their projects. So when we picked up the asset in 2016, we did a full-blown feasibility study to see what needs to be done to become a low-cost producer and also make sure that we can maximize the tons that we produce at site. And we delivered that first project on time, on budget in 2018. And as you probably saw with the results, in just a few months, we hit commercial production, hit nameplate capacity, and already started working on the expansion. And I think the biggest highlights for us, there was obviously what we did at the mine, but it was all the logistics side as well. So when you talk about bulks, logistics are extremely important. And not only the Quebec government, but also the federal government invested over $700 million in logistics at the port and on a small spur of rail to make sure that this operation can be efficient, and other operations in the region as well. So
let's talk about the your output at the moment. You've got 15 million tons of annual capacity or a projected output. Last year you produced closer to 8 million tons, and you've put in the second concentrator. So you should be able to, in theory, the plan is to ramp up that concentrator and to reach that nameplate capacity of 15 and possibly exceed it. Where are you in that ramp up process?
Yeah, so the end of last quarter, we were running at around a 12 million ton per year run rate. And we've since improved the operations. So we feel fairly confident that in the coming months, we'll be at full nameplate capacity of 15 million tons per year.
Of that, you've just produced this feasibility study to take 8 million tons of it, of your concentrate. So you produce a magnetite concentrate running 66% iron content, and you've just produced a feasibility study to upgrade 8 million tons of that to a 69% direct reduced iron feed. Is that right? Pellet feed.
Yeah, if we just take a little step back, we have the advantage of not having magnetite. So we actually have a hematite ore body, and that allows us to not have to grind down as fine to be able to reach these sorts of grades. So that's a big key difference for us because logistics-wise, we don't need to pelletize our material to be able to sell it to the market. And what we're seeing is there are more and more demand of this high-grade pellet feed because there's more and more of the steel companies transitioning their blast furnaces towards electric arc furnaces. And as they do that, they'll need the ultra-pure material. So our intent is to be able to take first half of our tons and being able to upgrade them to 69%. And just to put that in context, our hematite in the ground has oxygen and iron. So you can't go over 70%. The other 30% is oxygen. So when we say 69% material, well, it's actually one of the purest iron ores on Earth because we're about 99% pure on our actual mineral.
When I was looking through all your promotional material and your videos, there was no real mention of geology, and I am a geologist, and so I am interested in the difference between hematite and magnetite because magnetite is typically a very corrosive and a hard mineral. And talk me through the enrichment process. If you produce a 66% iron concentrate at the moment, presumably it's low in deleterious elements, it's low in silica and alumina. How are you going to, what is the actual kind of mineral processing steps that you do to get it to 69%? And I'm aware that you're a mining engineer and I'm a geologist, and I'm looking for that middle line between the two.
Yeah, the big advantage we have, and my wife is a geo that worked at Bloom Lake, so I get in the family a little bit of both. But if you look at the big advantage we have with our ore body, it's one, in the ground, it's fairly coarse hematite. And when I say coarse, it liberates at roughly about 1 millimeter. So at that sort of size, it's a big difference from magnetite ore bodies that you need to grind down almost 20 times finer to about 45 microns. So this is one of the advantages we have. And the second advantage is in the actual ore body, we've got pretty much only iron or hematite and silica. So we've got no phos, no sulfur, as you mentioned, no alumina or practically no alumina. So that makes not only a high-grade material, but a very low contaminant material. So when we separate it, it's a fairly simple process because silica is about half the weight from iron. So all we do is we pass it through spirals, a little bit similar to going to the water slides. The silica will go to the end, iron will stay in the middle. Then what we use are hydrosettlers. So it's a little bit like a flotation process, but inverse, and you'll float out the silica because it's much lighter. And we also do use magnetic separators, but they're high intensity magnetic separators to allow us to recover the fine hematite. So when you combine those three processes, that allows us to have an iron recovery of roughly about 83%, and at the same time produce today a 66% material. Now, to go to the 69%, essentially what we will do, we will take that material, put it in an addition to the phase 2 plant, regrind a little bit the material to just further liberate it, and then we'll use a flotation process to actually float the silica. And this is a known process in the iron ore industry. It's not anything new. And the big advantage that we have at Bloom Lake, again, is we don't need to grind very fine to be able to produce this. So the actual 69% concentrate, or what we call pellet feed, can be transported by rail, by vessel after, to be delivered to our clients without having to pelletize it.
I was going to ask, that was going to be one of my questions about, how do you get it to the pelletizing plant or the potential destination? Because typically when you are dealing with these ultrafine magnetite concentrates, you slurry it down a pipeline, you fluidize it to a degree, and then get it down a pipeline, which brings you into all kinds of different logistical challenges of dewatering and Blaine indices and that kind of stuff. But you can treat this as a fine product, essentially.
Correct. So we'll remove the water, bring it down to roughly about 2 to 3% moisture, and then it'll be able to go down the actual rail line, about 400 kilometers down to the port, and then be handled and put in bulk vessels, typically Cape-size vessels, and then sent to our clients.
Just going back a step, when you talked about the upgrade from the 66 to the 69%, is that a regrind of your final concentrate. So if you produce 15 million tons, 12 million tons of product, you'll take half of that and regrind that. Is that the bit that you regrind, or are you doing an earlier regrind earlier in the process?
Yeah, so the way that it's done, if you look at the way Bloom Lake is set up right now, we have our original concentrator that produces, call it 8 million tons per year. And there's a second concentrator around 50 meters away from the first one that is able to produce, it's a mirror concentrator from the first one. So that's why in our feasibility study, we came out with 15 million tons per year. And the intent is once the material has finished going through the second concentrator, so all that 7.5 million tons from that plant will then go into the flotation plant to be upgraded to 69%. And the big advantage for us is that once we see that market evolve, we'll be able to potentially install another one of these units beside our first plant and then produce a full 15 million tons of this DR material.
Okay, does that mean that the second concentrator is grinding slightly finer than the first concentrator to liberate more?
So the way that it's done is the concentrator will operate exactly the same way. And once we're at final concentrate, it'll enter the addition where there'll be some regrinding that'll be done at this stage and then pass through the flotation and then filtered to be able to send to our clients. So we take the end product essentially of the plant and then regrind it and process it.
Okay, great. Now, moving downstream step by step, just forgive the way my brain works. We come to the railway line. What's the capacity of that? And then it comes to the port. But first of all, the railway line.
Yeah, so it's a unique situation in the world, especially in the iron ore world, because it's one of the only hubs. And you have to remember, Canada is the second largest hub of high-grade iron ore in the world. And if you look at this area, it's actually got around an 80 million tons, 80 ton of capacity on the rail. And that's really a big differentiator because today, even with our expansion, we'll be utilizing about 40 million tons of that rail. So there's still 40 million tons of spare capacity on the whole rail line.
So when you say the 80 million tons per annum capacity, are there other users of that? Do you share the railway line?
Yeah, we share the railway line. So it belongs to the company IOC, our neighbors. But thanks to the first Prime Minister of Canada, he made the Canadian Transport Act. And when a rail crosses two provinces, you're obligated to offer the service. And there's a special arbitration process to make sure that it's not operated in a monopolistic way. So that's why we can get very good rates to get our material down, even if we don't own the rail. And when you look at who's using it right now, IOC uses roughly about 20 million tons, and we'll be at 15 million tons. And then there's a few small users that combine do about 5 million tons per year. So that's your 40 million tons being utilized today, and the 40 million tons of spare capacity.
Okay, and is it likely that you can maintain your current rates if you, let's say you eventually get to the third line and you're talking about another 7 or 8 million tons down the railway, will it be at the same rate? Do you get a reduced rate because you're increasing your tonnage, or do they say, right, now the next step is higher cost?
That's all a negotiation with the company that owns the rail. But typically, once you've had a fixed rate, it sort of sets a standard. So I can't tell of the potential negotiations for the future, but we do have a pretty good idea of what the costs are to operate the rail and what our potential cost would be as well.
Do they give you? Do you publicly talk about a ton per kilometer figure?
No, exactly. We don't. We've got pretty strict contract. When you look at our, we're a public company. It's fairly transparent. You can look at our total logistics costs, and that gives you a pretty good idea of what the rail contract is, but we don't disclose the official numbers.
Okay, thank you. And then we come to the port. I've seen some notes that there was some point where there was multi-access, berth use access, multi-user access. Could you just explain that and capacities and your opportunities there?
Yeah, so originally when we bought Bloom Lake from the Cliffs bankruptcy proceedings, we didn't buy the port. What we did is we partnered up with the Quebec government to be able to buy that infrastructure. And since then, the Quebec government has reinvested roughly about $500 million to modernize these facilities. You got to remember, these facilities were built roughly in about early 60s. So they needed a little bit of love, and the government invested roughly about that 500 million. They fixed all the electrical work. They redid some spur lines. We built a new stacker reclaimer. So all of that has been done. And so that facility today has a capacity probably of around 30 to 35 million tons per year. But with the addition of just a new car dumper, all the stockpile areas and the stacker reclaimers are in place. So with just a new car dumper, we could probably boost that capacity to about 50 million tons per year. And that would match perfectly the new berth, because the new berth can load Cape-sized vessels in under 40 hours, can load Chinamax vessels if required, can also load Panamax if we want to send smaller vessels to Europe. But essentially that berth has got a capacity of 50 million tons per year. And the difference with the users, we say multi-user, but today there's only two users. There's ourselves and Tacora. So we produce roughly, we'll be at a run rate of about 15 million tons. Tacora, I think in the past years, produced between 2 and 3 million tons per year. So you can see that there's a whole lot of spare capacity with that infrastructure as well.
So you won't even need to talk about a new car dumper until there's a doubling of capacity, really.
Correct. So if we, let's say, wanted to build the Kami project that we'll probably talk a bit later, well, that's an extra 8 million tons per year. That would probably require a new car dumper.
Goodness, because I've worked in iron ore, and it's the joke is when exploration geologists go from gold, as I did, to iron ore, that in gold exploration geology, you spend your entire time looking for the stuff, whereas with iron ore, the headache only begins once you've found the stuff. You know, actually got to work out how to get it out to market. And what you've just described there is a significant logistics infrastructure with capacity to expand at minimal capital expenditure to yourselves.
Yeah, I don't think you'd find that in many places around the world. We've visited quite a lot of iron ore regions, and you're typically bottlenecked on your infrastructure because that's where you want to be bottlenecked.
Yeah,
because that's the highest cost. And here we got a unique situation where the bottleneck is not at all on the logistics side. So as you mentioned, we've got much lower capital investments to be able to bring new tons of high-grade iron ore to the market.
In one of your presentations, you've got that slide where you talk about the average investment into iron ore capacity in the last 10 years relative to or iron ore production in the last 10 years prior to the decade earlier. But isn't that just a function of what you've just described? That 20 years ago, the majors, the four majors that kind of run the iron ore sector, invested in their own infrastructure, and since then they've just been working up to their kind of capacity limits, and so there's been no real money being spent on new projects because the cost of the infrastructure is prohibitive.
Yeah, and that's why when you look at potential view on the pricing of iron ore, in the past you typically had, well, when the price is a bit higher, well, you had typically Australia that would just ramp up the tons a little bit more and at a fairly low cost. So that created some sort of balance. But what we're seeing today is as soon as demand goes up a little bit, well, there's no new tons that can come onto the market easily. There's a few large projects around the world that have been in discussion for the past 50, 60 years, but there's nothing concrete that's necessarily been delivered. And it's tough to just do an increment of 8 to 10 or 20 million tons because you're bottlenecked at the infrastructure side.
Really, really interesting. Well, let's talk now on costs and margins, which have got two elements to it. One is the operating costs, and the other is the product premium that you're getting. So if you could just talk me through the costs in the first instance, and in your most recent financials, there's quite a long list of inflationary items in there. Now, the way that I see costs is that typically they go up much more easily than they go down. Could you just kind of are we here now on the costs? Are we living with steady inflation, and you've just got to live with that in your cost structure?
Well, we've got a bit of an abnormal situation right now in terms of cost, because we've been very good at delivering projects on time and budget, but you still got to remember that we are in the process of ramping up one of the largest mining projects in North America in the last 10 years. So today we're slapped with 100% of the fixed cost, but we don't have the full volume yet. So as we bring that volume up to its nameplate capacity, well, you'll see those costs going down. So I agree that it's tough to bring down the costs in typical situations, But if you're 3 million tons below your nameplate capacity at the moment, I think it's normal that our costs are a bit higher. And if you look at the last quarter, there's about $8 Canadian per ton that are associated to the fact that we haven't ramped up to the full tonnage yet. But the comforting thing for us is the fact that when the plant operates today, it operates over nameplate capacity. So there's no design issues with the plant. What we're doing now is ramping up the mine. Took a bit more time to get our mining trucks delivered than we had expected. That's always the challenge when you deliver a project ahead of schedule. I mean, we delivered the plant 3 months ahead of schedule, but then all the surrounding equipment is not necessarily following. So right now we've got all the equipment for the phase 2. It's being assembled, so all the trucks, the drills, and everything. So we feel very confident we'll bring that up and be able to bring that portion of cost down. Now, the second portion, the inflation, well, obviously we've been hit with higher fuel prices, higher explosive prices. I think that's pretty much through the whole mining industry, and also the contractor cost and the spare parts. So those are the elements that are more associated to the inflation that have brought our costs a little bit higher. But when you look at our costs, if you bring down that $8 per ton, bring us to a normal run rate, I think we're very well positioned to have significant margins for our shareholders.
And labour, thank you, by the way. Those are excellent answers. But now let's just talk about labour, the personnel for the mine. Is it coming down now that you're out of the construction phase? Is it stabilizing? What's your labour pool like?
Yeah, right now we've almost hired all of our employees for phase 2. There's a few specific areas that we still have contractors that'll slowly transition out, but the bulk of the contractors are out of the site now, associated to the construction or to the ramp up. So we've now taken full control of the whole operation and making sure that that's done with our own employees. So the cost of contractors, as you mentioned, is going to go down as well.
Is there a residential kind of culture there, or is it a FIFO, fly in, fly out?
We're a fly in, fly out model. So we operate in a small town, but the small town, all the houses belong to the other iron ore mine. So we have a fly in, fly out model. We've got all of our facilities at site, but it makes it a bit more interesting because you're not doing a fly in, fly out. Well, some people would say it's in the middle of nowhere, but I don't feel it's in the middle of nowhere because you've got a small town, you've got a grocery, you've got a place to go see shows. So it's a small, let's say 3,500 people a town that we fly in and fly out of. And our model is a little bit different, where we've got about 7 different points around Quebec where we fly people in, typically go to certain smaller villages that in the past had difficulties finding work. And that allows us to have a much more loyal workforce, because maybe a bit more time to train them initially, but then because we go pick them up at maybe 10, 12 hours away from Montreal of driving time, well, it allows to not, they don't have any other options of other fly in, fly out mining projects. So it allows us to have that sort of stability in our workforce.
Smart. I like it. I've also heard, talking about taking more time to train people. I was speaking to some of my mine finder friends in Africa, and they said that when they are building a mine there, and an open pit mine, they say the worst people to train are men who already know how to drive. And the best people, the best truck operators are women who haven't been taught anything on how to drive. So you can teach them right from the beginning, and they really look after the machinery. What's your gender split on your workforce?
Yeah, I'd say that I agree with what you just said. The issue is that you've got a bit of a bigger complexity to hire more women when you're a fly in, fly out operation. So we've found it harder. We've got over 10% of the workforce being women, but it's difficult to ramp it up because of the fly in, fly out model. So what we've been doing right now is trying to brainstorm on different ways that we can accommodate and different ways that we could potentially integrate more women at site. Where we've done a fantastic job in terms of diversity is in the region. We're by far the largest employer of First Nations. So we built a very strong relationship with Wasat Manitinam, the First Nations that claim the lands where we operate. And we've got about 10% of our workforce as well that is from Washat Manitanam.
Okay, thank you. Moving away from the local communities and the issues of labour to the and the flip side of the costs is to maintain your margin, or perhaps even increase your margin, your end product. So let's talk about where you sell your product, both the 66% concentrate and the 69% DRI in the future.
Yeah, so right now the numbers I'll quote you will probably not be reflective of this current calendar year, just because we're doubling our production. But if you go to when we were operating just with phase one, between 30 to 40%, depending on the years, would go to Japan. We would sell a portion into the Middle East, into Korea. We're selling more and more into Europe now, and the balance of the tons are going into China. As we transition towards the 69% material, well, then we're going to start selling closer to home. So we're going to maximize the tons that are being sold into Europe, Middle East, and even be able to enter the US market and potentially Canada as well. So our intent is to be able to lower our shipping costs. And when you look at the whole dynamic, you probably see it when you read any news about steel. There's significant subsidies from governments around the world to help steel manufacturers go from blast furnaces to electric arc furnaces. Just here in Canada, the government's invested over $1 billion to help two steel manufacturers convert. But when you look at who's actually going to supply the material for this industry, well, there's no projects being announced. So everybody's saying they're going to get scrap, but there's a finite amount of scrap, and especially the prime scrap. And what's a big advantage for material like we're going to produce is that the more scrap you want to integrate, well, the lower quality scrap you'll have to take, and you will need this high-grade pure material to be able to dilute down the contaminants. So that's why in the future we believe Europe, Middle East, US, and Canada will be our four best markets. So.
And what's the benchmark price that you set your product against?
So right now we sell to the P65 index. We've got a small premium to that because we're a bit of a higher grade, 66 material. But as we transition towards the 69, well, we believe in the future this pricing will evolve, and it'll be closer and it'll be linked to the scrap prices. Because essentially it's going to be a replacement of scrap into the same industry. So I think there's going to be a decoupling with the 66 or the 65, 62% index, and the DR material will be able to go closer to scrap prices. Because when you look at the curves, oh, go ahead, sorry.
Oh, no, go on, look at the curves. I mean, I was just going to ask, what is that difference? What is that difference?
Yeah, so today the spread between if we start between the 66 and the 62, that's changed depending of how China imposes environmental restrictions. So if you look at last year, there was a lot of COVID issues in China. They had zero environmental restrictions for steel production. So you had the margins for our material of between $10 to $15 per ton. But if you go back just 1 year, well, the premium went up to close to $40 per ton for this same material. So as soon as China puts restrictions for environmental reasons, so to lower CO2 intensity per ton of steel produced, well, then you want to buy higher grade material because for the same amount of CO2 emissions, you can pump out more steel. So right now, we're already seeing China reimpose some environmental restrictions. We'll see how that evolves this year. But we think that medium term, that's going to come back, and the premiums for that material are going to be pretty solid. Now, if we enter the 69% material, that's a whole different game, because right now, the whole iron ore industry is about 2 billion tons. The DR material is roughly about 150 million tons per year. And of that, only 30 million tons is merchant. So the rest, it all belongs to integrated steel mills. So of that 30 million tons, it's a pretty small market today. But what we're seeing is that with what's being built in terms of electric arc furnaces today, not what's been announced and will start in 2025, what's being built today, it's going to create an extra demand of 30 million tons. So the merchant market will double in the next 18 months potentially, and unless people miraculously find scrap for the feed of these materials. So in very short term, it's doubling. And if you look at the projections for 2030, it's actually about 4 times what it is today. So when you look at that, it's got the same increase curve as what is forecasted for lithium and graphite. And you can see everybody's excited talking about lithium graphite. nobody's talking about the DR material.
Nice, I like it. What's the scrap premium to the P65 benchmark at the moment?
The scrap premium, a few $100 when you compare to actual iron ore. So that's hovered as well, but it's priced in a complete different space. So the potential value accretion for our material is significant. It's not just a few dollars per ton. It can be in the many tens of dollars per ton for material that we would produce. Already today, if we were to sell DR material, what we're seeing is roughly between 25 to 30 US dollars per ton premium above the high grade index, so above the P65. So you can see already today it's a pretty good margin, but we see that potentially increasing in the future.
Interesting. Thank you. So let's just go back to that. Let's go back to that feasibility study. You've just put out the results. You published your NPV with using an 8% discount rate, which I was very pleased to see. For a mature producing company, that's a conservative discount rate to use, presumably reflecting your cost of capital, or perhaps not even, but it's refreshing to see that. Was that a conscious decision?
Everything we put out, we want to be able to achieve. So as we mentioned on the first few minutes, we own 10% of the business. It's a sizable business now, as you mentioned, $3.5 billion. And when we put out numbers, we don't want to pretend and make it all pretty if we don't think we can achieve it. And as you mentioned, in today's market, 8%, would it be a little bit better? Maybe, but that's the order of magnitude of the cost of capital that we would have. And when you look at the CapEx numbers, you even saw 350 million US. We put a significant contingency on that, and we used actual production costs that we had in terms of the construction for the phase 2. So we didn't base our numbers on previous numbers and on sort of dream scenarios. We put it on actual numbers that we think we can hit.
You talk about not getting ahead of yourselves. You're putting $10 million towards the advancement of this feasibility study, but you're only going to make a final investment decision on, and you mentioned two things. One was additional power capacity, and the other was non-dilutive funding. Could you talk about both of those, please?
Yeah, if we start with the funding, realistically, I do feel it's going to probably be a little bit like phase 2. We're going to put a financing package in place, but we'll self-fund this out of cash flow. But it's important for us, again, to be on the conservative side. So the last thing we want is that during the construction period, well, then there's a little blip in the iron ore price and we need to potentially go for financing at the wrong time. Better do that ahead of the project. And what we're looking to do, similar to what we did to phase 2, go see our banking partners and be able to have some sort of credit facility with the banks to be able to allow us to fully fund the project, even if there was potential issues. But I mean, you're talking about 350 million US over the next 30 months.
So that's effectively almost like a sidecar to your existing revolving credit facility, just to make sure that there's to smooth out any potential perturbations in the cash flow requirements over the next 3 years, 2.5 years.
Correct. Yeah.
Okay, thank you.
So that's in terms of the financing portion. When we look at power, well, realistically, the Quebec government has realized recently that there's quite a lot of demands for different projects, and they've transitioned also the Hydro-Quebec, so the monopoly that owns all of the electricity here in Quebec, has now transferred to the Minister of Economy, and they've just put out a new sort of list of requirements to be able to achieve, to be able to get access to power. And of that list, what we're starting to hear is that it needs to decarbonize the world. So we've got to tick on this one. It's got to be socially accepted. And as we mentioned, we've got the best relationship with the First Nations. I don't see any potential issues there. And it's got to increase productivity, which it will do. So I think we tick all the three boxes. We'll be able to see in the coming months, but I feel fairly confident we'll be able to achieve that as well.
Have you got a kind of a timeline when you'd like to announce an FID, or is that too early to say?
Yeah, so what the 10 million that we've authorized right now, it was to secure that 30-month timeline. So the counter starts, let's say, 1st of February. And we believe that by the end of this summer, we'll be able to potentially have the power secured and the funding package to allow us to take a full decision.
Okay, so end of summer within Q3, let's say.
Correct.
Good. Right, Cami, on the next expansion or another potential area of expansion.
I think if just take a step back from Cami, so we started with the view that high grade iron ore is going to be the future, and even today we believe that today's high grade is going to be tomorrow's low grade. So the new high grade is going to become this DR material. So what we've done over the past 5 years, while nobody was looking, we just accumulated the equivalent of about 10 Bloom Lakes in our portfolio in terms of resources of iron ore. And Cami was one of the best acquisitions that we made. It's a project that, if you go back a few years, had a market cap of roughly about $350 to $400 million, and that we picked up at a pretty good price last year. Now, what we want to do, there was a feasibility study that was done for that project. It's a feasibility study that we don't stand by. So as we mentioned, when we publish numbers, we want them to be things we can realize. And the second thing is that we don't feel that the market needs another 65% material. I mean, there's potential Simandou, there's potential projects out of Africa that could potentially service that market. We want to make DR material. So we're redoing the feasibility study now. That'll be delivered by the end of this year, and calendar year. And our intent is to be able to have an 8 million ton per year DR pellet feed material. So we're increasing the grade from the 65% to the DR material. We've done pretty much all the test work, all the lab work. The material is similar to Bloom Lake. It's upgradable to maybe not 69, but about 68 and a half. So we do feel that's going to be an extremely good potential for us. And as you correctly pointed out earlier, we've got all of the infrastructure already in place to be able to process that material.
Thank you. So it's another parallel stream to existing and known technology and process. You know, it's another. You're just kind of building up another silo, another stream. Yeah,
that would be a standalone project most likely. So it would be a mine with its concentrator to be able to upgrade the material to the 68% grade, and that would be an increase of 8 million tons in our portfolio of this high grade material.
And it would potentially come down the same railway.
Correct.
And
yeah, if you take aerial view, the two projects are about 12 kilometers apart, or 17 kilometers by road. So they're right beside one another.
And you're also looking at a pellet plant down by the port.
Yeah, we've been looking at that pellet plant for a while. It was operated all the way to about 2013. We mainly purchased it because of the actual location. It's at the best spot imaginable. It's right between our two stockpiles where we put our material at the port. It's got access to water, access to power. It's got access to all the port import potentials. So for the different materials you need for pelletizing. So it couldn't be in a better spot. So essentially we bought what we believe is the best location in Canada to build a pellet plant. The pellet plant's in bad shape. So we would remove all of the equipment inside. The building's in fairly good shape, so that would stay. But realistically, we would change all of the equipment inside to make sure that we've got a good operating cost pellet plant, and also using newer technology, because for the same size of plant, what used to be able to make 5 million tons per year today can make 8 million tons per year. So we're doing a feasibility study now to be able to have an 8 million ton per year pelletizer. And as we've announced, to be able to de-risk the project, we've partnered up with one of the largest steel mills in the world, also one of the steel producers that has the lowest CO2 intensity per ton of steel producers in the world, because we're fully aligned in terms of values. And we're working together to deliver that feasibility study.
I completely understand the reason behind not wanting to take it on yourself, because a pellet plant is a very different beast. It really is halfway to the complexity of a steel furnace or an iron ore furnace. Good. Timelines on the pellet plant, and kind of what's the trajectory of your evolution of thought on that look like?
Yeah. So if we look at our view, maybe that ties into capital allocation. Is the DR pellet feed? I'd be pretty surprised we wouldn't go forward. So obviously we need board approval and we need to finalize a few elements, but that will be able to take a decision this summer on this. Then at the end of this year, we'll be able to have all of the feasibility studies for the pellet plant and for Kami. And I do think that potentially those two projects are going to be put one against the other in terms of shareholder value accretion. So we'll look at that and at the different possibilities. And at that moment, it'll be easier to give a clearer timeline on when and if these projects could come online. But I think the good thing is that we're setting up the company to be ready to fully benefit from this DR material price increase in the future.
And you've been putting out this semi-annual dividend of 10 cents. Is that part of the planning? Are you aiming to maintain that dividend?
Yeah, and again, when management and directors own over 10% of the business, we're fully aligned with shareholders on potentially continuing to receive a dividend as well. So it's something that'll be evaluated every 6 months, but the intent is to be able to continue that dividend in the future.
Perhaps I should have asked this question right at the beginning, but what do you, when you're kind of plotting the grand scheme of things over your cornflakes in the morning, what do you see as the vision for the company kind of longer term?
So we've positioned this company to still be a growth vehicle. So it's very rare, I think, that you've got the types of iron ore resources that we have in our portfolio, the people that we have to be able to deliver the projects on time, on budget, and as we mentioned, the spare capacity on all the infrastructure. What we've done very well to position ourselves for growth as well is one of our major shareholders is the Quebec government. So they've made quite a lot of money investing with us, and they've supported us since day one. So I think we've set up the company in such a way that to be able to further expand here in Quebec and in Labrador, we're extremely well set up. We've got the resources, as we mentioned, and the team to be able to do it. So when I'm eating my cornflakes or my all brand to stay healthy, when we think in the morning on how we want to bring this company, we don't want to build just out of ego and out of arrogance. So it's got to be well timed in the market to fully capture these premiums. But the way that we're seeing this, we do see that DR material is going to be as required as the increase of lithium and graphite. We do believe that there's no other projects, at least that we've seen of scale, that have been announced to be able to supply that market. I don't know if you saw recently, but even Bill Gates invested in this company called Boston Metals, and they're finding ways to make green steel out of low-grade material. And they came out with the results that it takes 500 megawatts to produce 1 million ton of steel. And I'm not an energy expert, but I know that that's a whole lot of energy for 1 million tons of steel. So that still today positions high-grade iron ore as the only known way to decarbonize the steel industry. So I think we've got the great jurisdiction and the great team to bring that forward.
Thank you. Talking about your shareholder register, management and team 10%. How much does the Quebec government own? And can you talk me through any of the other notable blocks on your shareholder register, please?
Yeah, we've got the Quebec government and another fund out of Chicago, Windchurch, that are close to 9%
each.
Close to 9% each. So we've also got some large families that have been following Michael O'Keefe for quite a while out of Australia that own roughly about 20% of the company. And then we've got certain institutions that have come in as well over the years. So we've got a more balanced shareholder base that is built. We've got over half of our, or even more than half of our shares that are on the ASX and also of Australian shareholders. And then the rest are spread around the world here.
Sorry, Michael O'Keefe, forgive my ignorance.
Well, Michael O'Keefe, part of the management and directors, so he owns the largest portion of the
10%,
close to 11% total. Yeah.
Okay, got it. Good. Thank you very much. I look forward to seeing the progress and the updates as the company advances. It's been fascinating. Thank you very much indeed.
Yeah, thank you for your time. Always a pleasure. See you soon. Thanks.